Ready to pass the CPA exam faster? Visit cpapass.ai. Today's CPA AUD. How to evaluate the internal audit function. As the lead auditor, you are ultimately responsible for the audit opinion. While using the work of internal auditors or specialists increases efficiency, it generally does not reduce your responsibility. However, there is a critical exception under the applicable standard. If you reference a component auditor's work in your report, you actually divide responsibility. For all other situations, remember our core rule: never delegate responsibility. You cannot delegate final judgments. If you blindly rely on others' work and it is wrong, you remain fully responsible. Always verify and evaluate before you rely. Before relying on the internal audit function, the applicable standard requires you to evaluate three core factors using the mnemonic COQ. First, C stands for competence. You must assess their education, professional certifications like the CIA, and training. Second, O represents objectivity. Are they free from management bias? We look at their organizational status and who they report to. Finally, Q is for quality. Do they apply a systematic, disciplined, and well-documented approach? If any of these three elements are lacking, you cannot rely on their work. You must perform the testing yourself. Let's focus on competence, the first pillar of our COQ framework. To evaluate competence, you must examine objective evidence of the internal auditor's qualifications, look for professional certifications such as the Certified Internal Auditor or CPA designations. Review the department's hiring, training, and staffing policies to ensure they maintain high professional standards. You should also evaluate their experience levels and past performance reviews. While a highly competent internal audit department allows for greater potential reliance, remember that competence alone never completely eliminates the need for the external audit team to perform independent substantive procedures. Objectivity is the second pillar of our COQ framework under the applicable standard. To evaluate objectivity, examine the organizational status of the internal audit function. Who do they report to? If they report directly to the audit committee of the board of directors, objectivity is high because they are shielded from management pressure. However, if they report to a low-level manager or the CFO, objectivity is low. You must also review policies that prevent internal auditors from auditing areas where they recently had operational duties. If objectivity is compromised, you cannot rely on their work. There is a big difference between using internal auditors' existing work and obtaining direct assistance. When using their work, you review and test procedures they already performed. With direct assistance, they work directly under your supervision. Under the applicable standard, before direct assistance begins, you must obtain two distinct written agreements. First, get a written acknowledgement from management or those charged with governance that internal auditors can follow your instructions without entity intervention. Second, obtain a written agreement from the internal auditors themselves to keep specific audit matters confidential. Neither option allows them to make final judgments. And let's look at common examiner traps on this topic. Trap number 1 is delegating materiality or risk assessments. The external auditor must solely determine materiality and assess risk. These are non-delegable judgments. Trap number 2 is over-relying on highly competent internal auditors. No matter how qualified or objective they are, they cannot perform work in highly subjective areas, such as evaluating complex accounting estimates, asset valuations, or loss contingencies. The external auditor must perform independent procedures in these high-risk areas. Head over to cpapass.ai to practice these scenarios with our realistic practice questions and simulations.